Okay. So the question is, the main question is, why, after 23 years, we are doing this activity, still a lot of money managers, asset managers, family offices, portfolio managers not having considered the CLOs as an alternative within the fixed income market. But the question is very simple, or the answer is very simple, because simply they are not aware about the benefit and the added value CLO could bring over the time to a classical fixed income portfolio. So if, okay, I see the slides you highlighted. So look, consider 2000, we started in 2001. In 2001, we delivered a net IRR to our clients of 13% a year. 13% a year. It's during 23 years. It's a really huge, an amazing performance compared to the bond market, classical bond market. If we take our performance, for example, starting from 2016, the date where, since inception of Avenida, our fund of funds of CLOs, we achieved over 10%, 10.55% a year net IRR for our clients, for our investors. Now, these data, they are objective data that you cannot discuss. I mean, in the same period, just to give you some data point, Valentina, the classical fixed income market, so the investment grade aggregator, just to have a comparable, achieve 1.2% during the same period. So it means that from 2016, date of inception of Avenida, the classical fixed income market achieved at 1.2% IRR over the period. So we are talking about 8 years, okay? Now, the same period, for the same period, I mean, since inception, for the same period, Avenida achieved 85.8%. So 80 times more than the classical fixed income market. This is not to highlight Avenida, but it's to highlight the CLO market. You know, the CLO market, by definition, gives you a higher return rather than the classical fixed income portfolio. Even if we compare...
Alberto, which do you think is the main reason for this difference?
The main reason is because on the underlying of a CLO, we don't have bonds, but we use senior secured loans. Okay, senior secured loans, they have the feature that they cannot be speculated. You cannot short senior secured loans. You cannot how can I say, you cannot affect the market, because a senior secured loan, by definition, by nature, is nothing else than a contract between a corporate, and you name it, could be Hilton, could be Dell Computer, could be American Airlines, whoever, okay, and the banking system and the pool of banks and the credit market directly in the US. It's like to have or to ask for a credit line within a bank. I mean, normal investors, normal portfolio managers, they can buy the bond of Dell Computer or American Airlines, but they cannot they cannot invest into the senior secured loans. Okay, why? Because the bond is in the public market. Okay, having the bond in the public market, everyone can get it, can buy it, but they can also speculate on it. And another very interesting point between the fixed income and the senior secured loans is that senior secured loans, they are by definition all floating rates. So the senior secured loans get issued on a floating rate basis, while the majority of the fixed income market is issued with a fixed coupon, with a fixed rate. So this is another problem. having a bond versus a senior secured loans. That in case, and we face it in the last 3 years, we face it in case of interest rate hike. So the bond will suffer in terms of pricing because the interest rate went up, right? Of course, you have the benefit. Well, of course, you have a benefit if you will buy now a bond if the interest rate goes down. But in the same way, the senior secured loan, being floating rate, restrike is pricing every three months. So we don't get affected by the interest rate movement. Okay, this is just to reply your answer. This is also one benefit in investing in senior secured loans versus bonds. But I think the main feature of a senior secured loans is that the definition itself already described that you are senior. Senior means that you are in the capital structure of the corporation. Let's take it always Dell Computer or American Airlines. So we are senior to bonds. Okay, so the main benefit of investing in senior secured loans versus bonds, the classical bond market we know, is that you are senior compared to the bonds. So, and you have already, you name it already, three benefits. Okay, first of all, you cannot be under pressure of, or you cannot be affected by speculation. You are senior compared to bonds, and you are always floating rate. So it means you restrike versus the current interest rate market, right? Which is a huge benefit compared to a fixed rate bond. So why we achieve this number? Because of that, because of the nature of the underlying. The underlying, they are not bonds, they are senior loans. Okay. If we take for example, the default rate or the recovery rate of a bond market, the investment grade bond market, the investment grade bond market is 25 more risky than the investment grade senior tranches of a CLO, for example. If we talk about the bonds of a CLO. And I mean, the evidence in terms of returns and what we delivered since 23 years now, it's huge. It's huge.
Yeah, these are very important number in terms of performances.
Definitely,
and
definitely.
Yeah. And also, why do you think a lot of people don't have this instrument in their portfolio, given this difference in terms of performance?
That's a very good question, Valentina, because you know, we explore the market every day, and it's almost unbelievable, but a lot of professionals, they still not be aware about the existence of this market. A lot of money managers, that they are very much benchmark oriented. So when you compare your management style to benchmarks, of course you refer to standardized markets and standardized assets. Fixed income and bonds is one of them. By the way, just to be not confused, senior secured loans or CLOs, they are part of the fixed income universe. Okay, so let's avoid talking about commodities, equities, forex, and whatever. Okay, so senior secured loans or CLOs or loan market is part of the family, is member of the family of the fixed income. And you know, your question is very interesting, because I address always 8 to 9 questions to the potential investors, and one of them is, for example, are you invested in fixed income? The simple question is yes. Why? Because especially if we talk about family offices or private banking or retails, at least 50% of every portfolio is in fixed income, is invested in fixed income or have a fixed income exposure, right? So the simple answer is yes. And the clients reply that they are invested in fixed income. The second question is, would you like to improve or optimize your performance in fixed income? And due to the poor returns, the fixed income delivery the last 20 years, 10 years, 5 years, of course, the answer is yes. Everyone would like to improve a little bit or reasonably returns for the fixed income exposure in the portfolio. Why? Because almost 50% of them assets are invested in fixed income. Okay, but they don't have any decent returns, right? That's why they answer yes. They would like to optimize the results. Are you interested in a high diversification in your fixed income portfolios? And again, usually the answer of the investors is yes, because maybe they have, I don't know, 50 bonds in the portfolio. But if we talk our example, for example, but the loan market, our funds, for example, they have 1,300 corporates inside, right? So if you take a peer like our ones, and they are more or less above 1,000 corporations inside a fund. You
Well
don't have
diversified.
1,000 granulation. Is granulated the diversification? No, it's granulated. Why? Because we participate in a lot of corporates, so we finance a lot of corporates. And once you have 1,300 corporates inside a portfolio rather than 20 or 50, you see the difference is huge, okay? And the exposure per name is minimal, right? And in case of an event, the impact, you almost don't feel it, right? So, of course, higher diversification, the answer is yes. Or would you like to have a double-digit return? So it sounds crazy, no? In today's time, to have a double-digit return of fixed income, while we are talking about 4.5 right now, and we played the zero returns until 2 years ago. Okay, and of course it would be a dream to have a double-digit return in portfolios, especially in the fixed income. So maybe another question could be, would you like to decrease or avoid market correlation, in case of market events? And of course, who wouldn't refuse a lower correlation to the markets?
I think no one.
No one. So that's why, a lower correlation, higher diversification, double-digit return will be the nirvana dream of everybody within the fixed income portfolio, right? Why the lower correlation? Because actually, I told you before, actually CLOs that cannot be, or senior secured loans that cannot be affected by speculation, right? So you cannot affect my senior secured loans, but you can, in theory, you can short or speculate on a bond market or on a single bond, right? But not on senior secured loans. Why? Because the nature of the two instruments, they are different. Senior secured loans, I told you before, they are senior to bonds. Senior secured loans, they are not part of the public market, but they are part of the private market. It means banks versus corporation directly and not passing through the public market. So those are features they work in benefit to the investor and in the protection to the investor, right? It's very important to highlight that. what else I could ask them? Very important, for example, when you invest in an asset class, to have direct access to the managers. Not everyone is offering you the possibility to talk about the investment style, the investment strategies, the monthly report of an investment. What we offer, for example, but our peers as well, we offer a monthly report and conference calls to our investors in order to explain them what we have done during the month with our books, what we bought, what we sold, what we have in mind, what will be the next actions, what the amount of cash we have in the fund, what we're gonna do with the cash. We will keep, we will wait, we will invest. We are considering new issues, whatever, we have really an open discussion, and we are like an open platform to accessibility to our investors, which is very, very important when you manage portfolios, right? Very important.
Yeah. And also for the investor, do you think, for example, if we have an investor who doesn't know this asset class, do you think it is difficult to understand how does it work and the construction of the portfolio of loans?
Look, himself, the asset class is very, very, very simple, right? Like everything, like a house. A house is very simple to explain. If you go into the details, every wire, every bricks, every material you use, the material is complex. Of course, like everyone, if you try to explain private equity, private debt, private credit, VC, venture capital, all these investments, they are, if you go in the deeps, they are all complex, right? But the nature of the CLO market or the CLO business is very, very simple, and they can synthesize with a very simple reason. So the basic of a CLO investment is nothing else that the basic activity of a bank. A bank start his activity not to do private banking, investment banking, asset management, and so on, but just to offer a place where the people could bring them wealth on us in a safe place, right? And on the other side, the function of the bank, it was nothing else to support and finance the industry, right? That was the real nature of a bank, right? The bank, of course, the benefit of the bank is nothing else that benefit of the spread the bank pay to our clients, okay, for the cash deposited by the bank, and the interest rate the bank cash in for having lend money to corporations, to the industry, right? So the spread, for a stupid example, could be I got, 2% for my cash if I leave my cash in the bank, and on the other side, the bank receive a 4% interest rate from the corporation, right? The bank benefit of 2%, correct?
Yeah.
That's exactly how a CLO work. Nothing else. Exactly one-to-one. Same. How can I say, the normal people, they are replaced by institutional investors, and the corporation still the same. Still the same. The corporation, you name it, they can be Hilton, American Airlines, Dell Computer, and whoever, So the big differences between the bond market and the loan market, and we told you before, we are senior, but we are not only senior to fixed income and not senior to bonds. But we have also the protection of the money borrowed. For example, if you issue a bond, right? You as investor, you are the only one who take the risk of the bond, right? If the corporation goes to default, your recovery rate of the bond will be between 0 and 35% on average, just to give you some data, okay?
Yeah, yeah.
If you invest in a senior secured loan, your average recovery is between 70 and 100%, where 100% is usually the standard recovery of a senior secured loan. Why? Because you are, in terms of waterfall, the liquidation ranking in case of a default of Hilton, for example, okay? Me, as a senior secured loans, I'm the first who receive the money back. Why? Because I have in my hands a senior secured loans, not a bond. The bond is in the market, right? The senior secured loans is within me, myself. I own it. And by definition, the senior secured loans get issued from banks against some covenants, some guarantees, while the bond get issued in the market without any guarantee, right? So this is also a very important point. So we are senior, that's why the definition is senior secured. Senior, because I'm the first to receive the money back in case the corporation will go to default. I mean, just to come back to your question, why the people, they are not having invested in CLOs so far? Just because they are not aware about the benefit of investing in CLOs. The strange thing is that everyone knows about high yield bonds, right? High yield bonds is a very well-known non-investment grade bond family within the fixed income. Well, few people just know that the CLO market, or the senior secured loans market, is bigger than the high yield bonds. Can you imagine? So just to give you a data point. But you find in the portfolio of the investors the high yield bonds, investment grade bonds, and you don't find no one CLO investment tranche.
Yeah, this is a problem of education, maybe.
Yes, education, and the fact that it's true. The accessibility to the CLO market used to be less accessible than now. Now is accessible, right? Because, as I told you, the CLO market and the loan market get bigger and bigger and bigger in the US, to the point that almost 25% of the US industry is financed through the loan market. In the last 23 years, we saw, before, many years ago, the CLO market, it was mainly absorbed by institutionals. We raised, for example, over $1 billion, 1.1 billion of private money in the CLO market. So it's a decent amount of money of private investors in this asset class, and the trend is going up. So it's more and more private investors, or represented by family office or RMs or portfolio managers and so on. They are approaching this asset class. By the way, CLOs is an official asset class in the US. It's not a product, it's not an instrument, it's an asset class, like bonds, equity, forex, commodities, whatever, okay? So it's an asset class, official. And it's bigger than high yield. So it's something that now we should really start to be serious talking about CLOs.
Yeah, this is relevant.
Yeah.
Also,
but also the market developed in the 23 years the time we are working with, we faces just optimization in the market. You know, the loans that they got optimized after the great financial crisis in 2009. The protection to the lender, so which are banks or our money, okay. I mean, now the CLO market is really not only efficient in terms of returns, but efficient in terms of stability, in terms of consistency in the product himself, no, in the asset class himself. It's getting fine-tuned to the point that we reach today, where the CLO is really a great asset class for diversification in fixed income. Really fantastic.
Yeah. This is really important to highlight.
Yeah.
Okay.
I don't know what else to highlight in terms of numbers. Sometimes I'm speechless because I don't know how I want to compare our returns or the CLO market returns versus the classical or traditional fixed income. We have no comparable. You know, if we take the 20 years, where you get 20% on the fixed income versus 250% of the CLOs, is not a comparable. If I take just the last 8 years where we are working with our asset management company in CLOs, we achieve 85% versus 1 point something in the traditional fixed income. It's not a comparable anymore. We have more, how can I say, we are more closer to equity market returns in terms of returns. And on the other side, we have a more stable and more senior activity versus the traditional bond market. So you have a similar return of the equity market, having a more senior, in terms of protection as well, asset class in your hands. I don't know what to add. That's why if we enter in the discussion talking about numbers and features versus the traditional fixed income, I think the numbers they talk by themselves. I don't know what to add more than that.
Yeah, I think these numbers are quite clear from the side of the performance, and also for education. So for the investor, this number could be really interesting, but also education to understand how CLOs work can be very important. So
Of course.
also in our acceleration program, we have a lot of contents in order to make the investor learn about CLO's world, about Avenida world, because over the years you gained a lot of experience and you have the expertise to manage this kind of asset class. So this is really important.
We only do this in life. So, I mean, you cannot approach the CLO asset class as a generalist. We are focused on CLOs since day one, so 20 years ago, and we only focus on that. We are not distracted by other funds or other asset classes or other or structured products or derivatives. No. If you want to deliver this number and these results, you have to do this and only this, like a great private equity fund do. You know, once you start to diversify with real estate, private equity, venture capital, emblem, you cannot be number one everywhere. No, so we prefer to be focused. We are focused on this, and we consider ourselves a boutique. And if you want, a CLO investment banking, we only do this, since 23 years. And we focus all our expertise on that. Yeah, that's why also the communication to investors is very important. We want that our investors know about our activity and what we do.
Yeah.
Yeah.
Okay. So
Rather than
thank you.
that, I don't know what else to add, Valentina. I thank you for the discussion, but we talked many times about this topic, and it's quite difficult to add something more. I think the investor will get interested, maybe just because of the numbers, which are great, and they want to know more. Okay, we can go in the deeps of the asset class, and but will be very quite simple to explain how it works. There is nothing to hide in a senior secured loans. It's like to say, explain me the bond. Okay, the senior secured loans is a senior bond. It's not a lot more to add on that.
Yeah, in this case, it's essential to start from the number, I think, just to make people aware of the tangible performance of this asset class, and then
Look,
you can explore.
Maybe I can address a provocative question. A lot of people say, yeah, but the liquidity. The liquidity, I don't know if you experience that. Many people, they ask about the liquidity, because the bond market is cool because it's liquid, while our market is a quarterly liquidity. So we have a quarterly liquidity, fine. That could be a big issue for some investors. Now, my very simple question is, because we did the exercise and we questioned some clients, what was the benefit of the liquidity 2 years ago when the interest rates start to raise? What kind of benefit brought you to have a liquid assets in your portfolio versus it's not an illiquid asset, CLOs, it's a quarterly liquidity, okay, versus a quarterly liquidity? Simple question, simple answer is no difference. Because anyway, nobody reacted on that, and they faced the loss on the prices anyway, Why we benefit on that? Because we are floating rate, okay, with our instrument. So the liquidity is something that doesn't pays you out in today's time compared to what the difference is. For example, let's take from the COVID period. This is a nice data to highlight to clients, COVID period. So starting 2020 and year to date. So we are talking about 4 years, exactly 4 years. The bond markets, they went between -10 for the investment grade for the period of 4 years, between -10 and +10 of the high market. Okay, but if you take the investment grade, -10 for 4 years, -5 the government bond market, -2 more or less the emerging market, and just the high yield market for the period made +10. So aggregate, if you take a slice of everything and you combine your fixed income portfolio, you are negative over the period, okay? Over the 4 years, you're still negative. Why our less liquid? Because we have quarterly liquidity. We deliver 35%. Again, when we come back to numbers, is the liquidity issue that some, and I understand, of course, some portfolio managers address to us could be an issue. But my question is, this liquidity premium it's cost you 40+% to the end client. Is something that you can justify in front of the client? I don't think so. Plus, we are not asking to replace the current fixed income portfolio with CLOs or senior secured loan. We are just asking to have at least a participation to the CLO market and not 100% exposure to the fixed income, classic traditional fixed income. No.
So thank you, Alberto. I think this was very highlighting from the side, both from your side, both from the investor side. And it's important in this asset class to start from the real number in order to understand the positive impact that a CLO could have in a portfolio.
You know, the real number or the numbers we deliver in the last 23 years is something that you cannot discuss. Is an evidence, you know.
Yeah.
How we get this number is very simple. Behind, instead to investing in bonds, we invest in senior loans, nothing else. How senior loans work, I'm more than happy to explain you, but don't think it's different than a bond. It's just you're just senior to bond, you know, because you get some guarantees, covenant protection, blah blah blah. Okay, versus bonds. The only difference is that bonds, they are part of the public market. That's why everyone can buy and sell and short and speculate and whatever. While the senior secured loan market is the private section of the capital structure of a corporation. Is not in the market. Is between banks and not in the market. Okay, that's the only difference. But happy to explain or support you in explaining to your clients how a CLO work, of course. Anytime.
Yeah, there are a lot of possible details an investor could go into, and also starting from our content, we made a lot of research about the functioning of CLOs, and I think this could be interesting from the investor side.
I think more and more you learn and more you go in the deeps of the asset class and more interesting. Turns
yeah.
know, it's a very interesting asset class, CLO market or the senior secured loan market. Very interesting. Because the main biggest difference is that with the senior secured loan market or the CLOs, you finance the real economy directly. You know, you don't go through the financial market. You finance the corporation, the industries directly. You know, that's the beauty of and that's why it's less correlated to the financial market. By the way, that's one reason why it's less correlated, because you finance the real economy directly. And it's more concrete, and you receive, guarantees, covenants, physically, you know.
Yeah,
that's interesting. It's more fascinating and more safety for the investors, by the way. You know. I don't know if you have any other question. Let me know or call me anytime, and I will be available to support you. Okay.
Thank you, Alberto, for all
You're
this
welcome.
information, and also for the time, of course.
You're welcome.
This
anytime.
was really, I think, this could be a very important insight for our network of investors, and because maybe some of them have heard about CLOs, about the asset class, but have no idea about the numbers. In this case, we are talking about specific Avenida numbers given by your work, and but this is objective. This is really important.
Sure. And you know, we maybe another point that is very important. We are very picky with the counterparty we are working with. So that's why out of 170 CLO managers in the US, we work just we consider just 20 CLO managers, which are the best of breed and the tier one who drive the CLO market in the US. Okay. And out of these 20, we work with 18 of them. So we never compromise on quality in our portfolio. Never. That was the key of success and achievement of our results, because we never compromise on the quality of our counterparties and partners. Never.